Its financial stability report saying that the Indian financial system remains resilient with a healthy balance sheet amidst elevated global uncertainties. Bad loans expected to stay near multi-decade lows, and banks have adequate capital buffers even under adverse stress scenarios. Lata's here with the details. Lata, it's pretty sanguine news coming in there from the RBI as far as the banking sector stability picture is concerned.
That's well put, Shireen. I would summarize it in just 4 words: global risks, but domestic bliss. That seems to be the message from the Reserve Bank, but it's not surprising. When the global risks are known, the financial system and the global economy are seeing elevated trade and other economic policy risks. Financial markets are volatile, especially the debt markets, the bond markets, the Reserve Bank points out. And it says that while these are new risks, the old vulnerability of very high public debt, whether it's US or China or EU, all developed areas, showing high debt, not to speak of emerging markets. In this scenario, you have an Indian economy which is actually the key driver of global growth itself, a big contributor to global growth. And it is a growth underpinned by macro stability. Very good macros. You spoke of fiscal surplus just a while ago. There's also a current account surplus. So macros very sound. In the financial sector itself, whether it's banks, NBFCs or corporates, all of them are showing very healthy balance sheets. As the Reserve Bank puts it, the financial system itself is very healthy because of rate cuts, liquidity infusion, and of course the CRR cut that's coming. The stress tests are showing that mutual funds and clearing corporations are also relatively resilient. You must remember that the FSR covers all financial sector elements, and the insurance regulator points out that the consolidated solvency ratio of the insurance sector remains above the minimum threshold limits that are set. But as always, the FSR concentrates a little more on the banking sector and the NBFCs. There it points out, as you said, GNPA, that's gross bad loans and net bad loans, are at multi-decadal lows. Gross NPAs at 2.3%. I don't know when we last heard that number. And net NPAs at 0.7%. But there is also a scenario building that the FSR does. What if scenarios? As a baseline, they expect that this is the lowest that GNPAs will be. In the baseline, they're likely to rise to 2.5% in March 2026, in 27. And capital adequacy is likely to fall a bit from 17.2 to 17, which is way above Basel limits. And the CET, which is the common equity, actual share, equity shares, that percentage also is expected to rise actually in the baseline scenario from 14.6 to 15.2. But if there is an adverse scenario, then the GNPA can rise to 5.6. In a slightly less adverse scenario, goes to 5.2. And that's the capital adequacy, which can dip to 14.2 and to 14.6. The common equity can dip to 12.5 and 12.9. Even then, it will be above the Basel level minimum threshold limits. NBFCs also, gross NPAs at multi-quarter lows, multi-year lows of 2.9%. Again, if you apply the baseline risk, it can go to 3.3 by 1 year. That is March 2026. Capital adequacy can dip at the baseline scenario. So the baseline indicates that we are seeing the best ratios now. And things may worsen just a wee bit in a year, but this is really a Goldilocks scenario for banks and NBFCs. The only point that the Reserve Bank makes, both for banks and for NBFCs, is that credit growth is very slow. For banks at 9.6% in mid-June, and for NBFCs as well, it is at multi-quarter lows.
So credit growth worry, but on balance, it's good news coming in from the RBI as far as the banking sector is concerned. Lata, many thanks for joining us there to give us the highlights of what the RBI has to say in its financial stability report. Now, the government is set to